Hello and welcome, everybody. I'm Vern Cushenberry, your Chief Investment Officer, and I'm back with another quarterly market update. And I have a lot to share this quarter. As I look at the markets, I'm reminded of an old saying that says, bull markets climb a wall of worry. And I think back to earlier this year with the tariffs and the turmoil in the Middle East and bombing Iran's nuclear facilities and ongoing conflict in Israel and Gaza and Ukraine and the big, beautiful bill that added $6 trillion onto our forecasted budget deficit. And now the government shutdown that's on day 3 and may be resolved by the time I get this video out. I don't know, but markets do tend to climb a wall of worry. And in the midst of that, we continue to hit all-time highs. So I've pulled a couple charts out from my bag of favorites that my hope is will alleviate some concern as I look at the current economic environment. Yes, I do see some stretched valuations, but I also see pockets of opportunity. And at the end of the day, I'm going to tell you that a 60-40 portfolio, which is 60% equities and 40% fixed income, that has been powering the successful retirement plan blueprints of investors for decades, I'm going to tell you that still has a lot of merit. So let's jump right into it, and I'll share some data. And as always, I love questions, so reach out to me anytime with questions about the market. I love hearing from our clients and investors because it gives me an opportunity to speak about what I know is relevant to you. So here's a chart that I share every quarter. Again, we're looking at markets at an all-time high. As I look at this chart, of course, I see the S&P 500 trading at 22 times earnings, but I also notice some of the other key performance indicators, primarily here, which is a 10-year Treasury yield. The yield on the 10-year Treasury is currently 4.2%. It hasn't been that high in the last 10 years. We have to go back to 2007 to see similar numbers at 4.7%. So when I talk about the equity markets, the S&P 500, being at all-time highs, when I talk about valuations being a little expensive or a little stretched, well, this is the basic theory of diversification. Don't put all your eggs in one basket, which is why we diversify those portfolios across both equities and fixed income. And your fixed income investments now are paying more than they have in the last 10 years, which gives investors a little bit of a buffer there if we are going into that next recession, which that's another conversation I've been having frequently. One thing I know with certainty is that the economic cycle is not dead. We will go through another recession. It's just a matter of timing. And that's nothing to be concerned about. Recessions are a normal and healthy part of an economic cycle. Here you can see valuations up around 22 times earnings. And again, keep in mind that this is for the S&P 500. And as I've talked about in prior quarters, this bull market is largely driven by artificial intelligence. So when we factor out the huge gains of the Magnificent Seven, we see a market that looks something a little closer to fairly valued. When we look at international markets, we see markets that look a little closer to fairly valued. So I view those as pockets of opportunity, which is one of the reasons at the top of the video, I say at the end of the day, I'm going to make the case that that 60-40, that globally diversified 60-40 portfolio still has a lot of merit. So let's look at artificial intelligence a little bit, and the names that have really been driving that outperformance are the Magnificent Seven, which include Alphabet, Amazon, Meta, Microsoft, Oracle, the familiar names. But what really strikes me about this chart is just how aggressive the market views this opportunity. So if you look at the next 3 years, what we're looking at are forecasted capital spending. So infrastructure budgets, think data centers, think research and development, and other infrastructure gains. Next year, these companies are expected to spend $347 billion, followed by investments of $422 billion, followed by another year of $467 billion. So that's over $1 trillion in expected capital expenditures over the course of the next 3 years. That's a huge boost to our economy. And we're likely to see the benefits of that accrue to the S&P 500, in particular to the Magnificent Seven, but also to other companies. There are a number of companies that have cited artificial intelligence initiatives on their earnings calls in the last 3 quarters is well over 50% of the S&P 500. Now, I did mention that the economic cycle is not dead, and we will go through another recession, and I'm starting to see maybe early indicators of that. This is certainly one of the data points that jumped out at me this quarter, which is job openings. And we've seen jobs data as measured by a variety of different indicators on this slide. That's all moving in the downward direction. So that may be a harbinger of a contraction to come in the next few quarters. I can't say that with certainty, but it's certainly something that has stood out to me. And this is data that the Federal Reserve is monitoring closely and has been part of the justification for at least one interest rate reduction thus far. And I suspect we'll likely see another in the near future. Okay, let's look at just a few of those pockets of opportunity that I mentioned. Here we're looking at valuations of global markets. So if I look at the US market, let's just take this one, and I'll try to explain this chart here. We're looking at price to equity ratios. So prices in the numerator, earnings, price to earnings ratios, earnings are in the denominator. If you measure that, the S&P 500, like we looked at just a moment ago, currently trading at 22.8 times earnings. Now, the purple dot in this band is where we are today, 22.8 times earnings. The blue dot in this band is where we were at the beginning of the year. We were at 21.5 times earnings at the beginning of the year. So we're just a little bit more expensive than we were at the start of the year. Now, the gray band is the 20-year range. So in the last 20 years, we're about as expensive as we've been. We've been as cheap as, just call that 10 times earnings in the last 20 years. And then when you look at the light gray band, that would be the 20-year average. So we're significantly above the average and close to as expensive as we've ever been, meaning the US market that has indicated by the S&P 500 in the last 20 years. But look at Japan. Well, Japan is just maybe a tick over their 20-year average. Let's look at the Eurozone, right there within what you would think to be a reasonable range. The emerging markets, a little bit more expensive. That purple dot is closer to the top end of the range. China, I would call that a very reasonable range. So my point is here that when we look inside the US markets and we factor out the stocks that have done so well on account of artificial intelligence, we see pockets of opportunity. And when we look outside the US markets towards Japan, the Eurozone, China, emerging markets, we also see pockets of opportunity. Okay, and lastly, I want to leave you with some broad perspective. I always try to end these videos with a 50,000-foot perspective, and this is always timeless wisdom. These are investing truths that I cherry pick to try to put a little bit of reassurance on these videos. And what you're looking at here is the returns to that 60-40 portfolio. This is your typical retiree. So you're in that age band of 60 to 70 years old, you're almost to retirement or just retired, and that 60-40 portfolio is pretty close to what powers most of those portfolios for your typical retiree. So when we look at that portfolio, 60% equities, 40% fixed income, what you see here is that the gray bar reflects the percentage of time that portfolio was positive. If you look at the 1-month performance, let's just call that close to 70% of the time. Actually, there it is, 67% of the time, that portfolio is positive. And that percentage increases as you widen out the time span. So if you look at a 3-year period, 87% of the time over any 3-year period, if we look at all 3-year periods dating back to 1995, 87% of them had a positive return. And by the time you get to that 5-year period, you're up to 99% of the 5-year periods in that span had a positive return. And once you get to 10-year, you're at 100%. Now look at the green dot, which indicates the percentage of time that 60-40 outperformed cash, or what you might think of as a money market portfolio. So we're trying to keep up with inflation here. And the data is just as strong. by the time we get to that 5-year mark, 80% of the portfolios, and by the time we get to that 10-year mark, 91% of the portfolios had outperformed that inflation type benchmark. So again, this is good perspective on what you're likely to expect in the future. Try to wrap up all these videos with a little bit of information that helps everybody sleep well at night. Now, of course, this has to be integrated into your financial plan. So reach out to your advisor and do an update at any point. We're nearing the fourth quarter, which is always a good time to review your financial planning, tax management, those types of conversations. So rest assured, I'll be back in another 3 months to try to put some perspective on the headlines of the fourth quarter. And thanks again for your time.